People call us all the time, and we'll walk into a house and say, oh my goodness, I wish you had talked to us before you had purchased this. I'm not here to talk you out of deals. We want you to buy deals because we want to manage them, but we might have helped you dodge a bullet had we just laid eyes on this thing before you wrote a check. There's things I think a lot of investors don't realize about property management because the devil's in the fine print. People will call us and they'll say, hey, I'm paying this, and they'll send us their contract and say, no, you're not. You're paying 3 times that. You didn't read page 6, 7, and 8, where every time the phone rings, there's another fee.
This episode brought to you by Suites at Madison. Meeting and conference rooms for rent by the hour, week, month, or year. Suites at Madison, where business gets done. Check them out at www.downtowntampaoffice.com. Now, on to the show.
You are listening to the Invest Florida Real Estate Show, covering topics in lending, buy and sell strategies, property management, hot markets, and tips and tools to guide you along the way on your path to real estate success. You want Florida investment real estate talk? You have come to the right place. And now, our hosts, Eric Odom and Steven Silverman.
Hello and welcome to another episode of the Invest Florida Real Estate Show. This is your co-host, Eric Odom, along with Steven Silverman. Steven, I noticed you were absent for most of the day today. Did you get another free lunch?
Who says there's no such thing as a free lunch? But the Florida Gulf Coast Commercial Association of Realtors had an event where there were panelists talking about the deal of the year. And actually, Eric, I got some compliments. There are people there that listened to our real estate podcast and had nice things to say about it. One of them said to some other brokers, what are you doing listening to the radio while you're driving? There's a great place to go and listen and learn something.
Yeah, that's nice compliment that we get. Sometimes we go out. It's funny when we go out into some of these broker groups and some of them have no idea what we do and others know right away. And it becomes a point of conversation immediately with them. And of course, they have their own ideas about which way the show should go or what we should talk about or not be talking. But it's good stuff. It's good to be able to go out and sort of mix and mingle with people and talk about the show and talk about real estate and other folks that are also on the same page as us in terms of the real estate business. Steve, got an email today from, actually not today, it was last week, from a Steve in Fort Myers. And he asks, do you manage property in Fort Myers? If not, who should I use? Do you have anyone that you know that you could refer? Well, that's a great question, Steve, but I'm not really sure what type of property you mentioned or what type of property you own. We do commercial property, and depending on the type of deal, we might take a Fort Myers property on. Love to talk to you a little bit more about that. So if you'd send me an email or give me a telephone call, I'd be happy to talk about it. On the residential side, though, and the multifamily side, we do not manage those types of properties. We only do office, industrial, and retail. But interestingly enough, it just so happens that our guest today is a single family residential manager who covers a large part of the United States, but he has significant presence here in the state of Florida. And so this could be somebody, if you listen to him, you like what you hear, that you could actually talk to and see about working with him. Looking forward to having this conversation today, Stephen, because we've not had a lot of folks talking property management with us.
And this is a different type of property manager. He approaches it from a different angle. We'll all learn something.
Guys, also, before we get started, if you have not done so already, would greatly appreciate if you would leave us a review on Google or iTunes. It helps us a great deal because it is tough for us to get guests. Everybody who appears here is working hard and their schedules are full. So they have to know that there's folks paying attention and that there's a reason for them coming on the show. So your comments do help give people the idea that this is a show that's worth coming on and investing their time. So if you've not done so already, appreciate you go to Google or iTunes and leave us a review. And we'll be happy to read your name out and talk you up when we have the next episode. Let's roll on to our guest.
Today we have with us David Diaz. David is co-founder and head of operations of a tech-enabled property management firm called Great Jones. Dave is a foremost expert in property management of single-family home investments. He has bought, renovated, leased, and managed over 10,000 homes for investors such as Waypoint Homes and other large investors, individual owners, and his own portfolio. David has set up systems that allow Main Street investors to achieve Wall Street results. David, welcome to the Invest Florida show.
Thank you so much, and thanks for having us.
Hey, David, really happy that you're here and investing some time with us today. Can you kind of give us you guys are property managers and investment advisors, and how else would you, from a 30,000 foot, sort of define yourselves?
Sure. So Great Jones is the fusion of technology and on-the-ground local operations that bring institutional level expertise to democratize property management for Main Street investors. After almost a decade in single-family management and investment, and having worked at multiple national REITs, we, a faction of us, let's just say, broke off and partnered with some amazing technology and experience folks that are based out of New York. And we are building a platform and a service operation to give you can be a dentist in Ohio with 3 houses, or you can be an empire building person locally who's trying to add to their portfolio every year. But either way, we give you access to the pricing, benefits, performance expectations that a Wall Street REIT would have for internally managed properties. And it really is a next level type performance on the assets. And
when you're talking about data, you're talking about lease rates in the market, and or is it more cost basis? Or what are you talking about?
Yeah, that's great. So we've used a lot of big data. Obviously, real estate's full of data, and we love data. Every part of this business is bettered by data. There's a little bit of gut, or actually a lot of gut in residential. But at the same time, when you've done 36,000 leases, you have a lot more data on what makes a successful outcome for a resident applicant than you do if you do 100 a year. When you've bought thousands of homes, you can get to a much better variance on what cost is going to be to renovate them than if you bought 1 or 2, right? Those outcomes can be pretty wonky. So just doing everything in large numbers gives you all of the edge cases to get your numbers much more within tolerance and much more predictable. So we really do apply science to saying, like, we think this is going to lease for this. Okay, that's not, lick your finger and stick it in the wind and hope that that's where that lands. That's based on thousands of data points to say that in this neighborhood, we see this transaction volume, this time on market, with these improvements, we can get this rate. It's a pretty good guess. I would call it a very good guess.
How did you get started in the business?
I was a commercial finance guy by trade, went to business school at Florida State, and have always focused on real estate and finance. When math became interesting to me, when you put a dollar sign in front of it, I didn't care much for calculus, but the moment I saw that dollar sign, I thought, whoa, this is super fascinating stuff.
I saw that with Eric in a restaurant when the check came.
His eyes got big.
You never saw. That's a lie, because I went to the bathroom.
That's right. So math became really interesting, and I was a commercial guy. I started in lending and Wall Street stuff, securitizations, all that. And when the market imploded, I was actually a commercial multifamily guy. When the market imploded, I saw this huge opportunity. I actually have a deck from 2009 trying to say, hey, somebody just give us a bunch of money to buy houses. And unfortunately, at the time, I was a really young kid. Nobody's going to hand me hundreds of millions of dollars to buy residential real estate. But I realized we were based at the time in Lee County, Florida, which was constantly toggling with Las Vegas as the #1 foreclosure market in the country. And I partnered with a local person who taught me the ropes, and we as a company became the largest auction buyer on the west coast of Florida. We were flip this house on steroids, something like 300 to 400 flips per year. I went out and raised institutional money around that from my past life, and we were turning anywhere from 30 to 40 properties a month as a flipper. Okay. So,
and what type of margins did you typically look for as a flipper?
That's funny. In 2009, nobody believed it. I kid you not, we had a 418% annualized return on cash.
Oh my God.
I had to dumb it down. We actually doubled our rehab cost versus actual, because that was the only non-verifiable piece of data in our, buy and sell were public record. So when I had to go raise real money, I had to actually pretend we made half the money we made, because nobody believed the actual money we made. They said, so oddly enough, at 400%, nobody wanted in. At 200%, everybody wanted in. And that was a sweet spot to raise money. But the downside was nobody wanted to hold. When we were buying new construction homes in North Cape Coral that were $300,000 at peak, no one would take them for $35,000. They wanted to sell them for 65 immediately. Nobody wanted to hold that asset until it was worth 200 again. I got to be honest with you guys. If somebody had given me $100 million in 2009, I'd be on a private island right now.
Right.
We wouldn't be having this conversation. But no one would hold. They wanted out as fast as we could get the money redeployed. And it looked great on a spreadsheet, but it wasn't a real wealth aggregator. It was just great return on smaller amounts of money.
And running on a treadmill.
You're only as good as your last deal. Anybody who flips knows that there's, you can make great money, you can hit home runs, but you've got to immediately start over.
So how did you progress from doing all your own flips?
We were blessed that a large fund came in. This is right when the Wall Street REITs started coming in. And we were approached by one of the first. We were fortunate enough to be one of the largest, I believe the largest, I don't know the data, but I don't think anybody was larger than us on that coast. And so if you were to call the courthouse as a Wall Street guy from New York and say, hey, who's the player? There was only one name you were going to get. So we got a few phone calls, and one of them ended up panning out as being a Wall Street group that wanted to start buying and aggregating homes. And when somebody calls you and says, hey, I want to spend, $5 million a month through you, are you willing to do that? And you're basically a brokerage. Your answer is yes.
Then you say any friend of yours is a friend of mine.
That's right. If you can't beat them, join them. Oh, and by the way, I'm going to take all the margin out of the business. If you don't buy them for us, the guy next to you is just going to outbid you on everything. You say yes. You join them. And that put us in the whole bottom of the market, say under 300,000. We were able to aggregate for rental, and then we could still do larger flips on the $500,000, $600,000, $700,000 house that didn't make sense as a rental property.
You've got multiple offices. Where are you all located? Florida's one of your offices, or you actually have multiple offices in Florida, don't you?
Yeah. So Great Jones is it serves the entire west coast of Florida up through, so from South Naples to North Tampa Bay MSA and over into Orlando as far east as Deltona. So we have Orlando, Tampa, and Southwest Florida offices. We also have an office in New York. We build our own technology. So we have an amazing team of people that work on nothing but resident and owner experiences for our customers. And we build technology in New York. We're a stone's throw from Google and Facebook and those types of players in New York City.
So let's have an understanding of how you operate. I'm going to buy a home as an investment. Do I come to you and do you help me find the home, or do I come to you with my home? And I'd also like you to speak to what kind of advantages you give to the individual investor.
Sure. So we focus exclusively on property management. We're not a retail brokerage. I mean, we are licensed brokers, but we don't buy and sell real estate at this point. What we are here to do is truly democratize the experience for people who already own. So we're not going to disrupt a relationship if somebody has one with a purchasing broker. We're happy and we help people constantly validate the assumptions in a purchase. So just like you would in a commercial building, you might call a property manager to validate, what really is market occupancy. Can I get this lease rate for the property? Brokers can be pretty aggressive when they're trying to sell you something versus what actually happens after you own it. So we help people all the time validate on the way in. But at the same time, we're not here to push a product. I did have several owners ask us for product because they already had some and we're trying to buy more. And we did partner with a regional builder. We have a product. We do not build it, but we send you directly over to this regional builder. We have a build to rent product. And the only reason we agreed to do that was I had so many requests from existing customers. And just to be honest with you, to train a fund to buy at auction is one thing when they're deploying millions of dollars consistently. It's worth the brain damage and the education. To do it with a customer that might buy 2 homes, one, there's not a large enough sample to average out the data. So if you have one tough purchase, a hidden issue or something else, it really is a true problem for that investor. Whereas somebody buying 100 homes can have one bad one and one good one, and it all averages out in the bell curve. So we didn't ever want to be on the other side of that equation with somebody who couldn't get to scale. But the build to rent product is interesting in that it was a consistent thing. We could guarantee the outcome. We validate the location for the investor. We connect them with a land broker. The builder builds it. And with a high level of certainty, we can predict the outcome of, initial rents, occupancy, all that sort of thing for the investor. Yeah, you don't
have that issue of looking behind the walls and seeing, a big mess. It's a new build. You know exactly what you're getting.
That's right. And we did help kind of bulletproof that. So one of the interesting things we learned, and anybody who's flipped versus owned rentals would understand this. I'll never forget, I think it was my 4th rental house that after all these flips, we're 1,000 homes into flipping, and we do our 3rd or 4th rental, and we're tiling the common areas, we're carpeting the bedrooms. And I'm looking at this going, we're using nearly white carpet. Like, what is wrong with us? We just threw our flip specs right at the rental. And I remember walking this house with the GC going, this is going to look terrible in a year. Like, we're using bone colored grout. We've got light tile. We've got nearly white carpet. Like, this is not a rental spec. This is something that we were setting up for flip. And so one of the things that I think separated us early on and allowed us to go big with institutions was we got really smart really fast. Whereas other people went hundreds of houses deep, we went to LVT flooring, everything solid surface, just bulletproofing a house as fast as we could. My 10th house for rental looked nothing like the first house for rental, whereas I have a lot of friends that got hundreds of houses into rentals before they got really smart about durable goods, consistent specs, all the things that eventually lower your turn cost and your cost to maintain. That starts at the beginning of the deal. What people don't understand is if you come halfway through a portfolio's life, you really can't impact the numbers that well. You've leased it to whoever you're going to lease it to. You've improved it the way you're going to improve it. Everything else is modifying the trajectory of a bullet that's already been fired. This thing's going where it's going. You have limited influence. If you're just the wind, you have limited influence at that point to change where it's going to land.
So you're putting money and you're being very careful about how you put money into your investment so you can maximize your value. But for an investor, is there a sweet spot in terms of the price to pay and what rent he can get? Because, the price of houses go from $100,000 to $2 million, but the rent that you get is not commensurate with that. I just wondered if there is a sweet spot that you guys use.
You're talking about the size, Stephen?
Yeah.
The size of the deal?
The size of the investment.
Yeah, sure. So it has been really interesting to see people try to make investment properties, especially with the advent of short-term rental and Airbnb and some of those phenomenon that are fairly recent out of much more expensive assets, right? Because there's kind of a natural ceiling to what makes sense as a true annual rental property. And it will depend a little bit on the median rent of a given market. But the reality is if you get much past, say, a 100 GRM or something like where a house that rents for $1,500 a month, if you're paying much over, say,
Dave,
$15,000.
You can't be using these terms with Stephen. You got a GRM. You got
a grandmother's rose.
Yeah. Okay. Yeah.
Right. So, right. So let's just say this. If, we want to make sure we're running somewhere between a 12 and a 10 gross capitalization rate. We all know what that is, right?
No, let's explain to people. Let's assume that people don't know.
Okay. So a house gets $15,000 a year in total gross rent, right? That's rent times 12. You're got to keep that in something like a 10 to 12% range on, so divide that by 0.1, 0.12, and that's about what you want to pay for something in the real world. Now, we see a lot of people come to us and they say, hey, I've got this, $750,000 house. I want to retire in it in 5 years. What can I get for it now? People make residential purchases for not 100% investment or spreadsheet driven reasons. Right now, we're renting several really nice homes in Naples, for example, that have no business being an actual rental property, but they are, I wouldn't even call them speculative purchases. They're almost like future retirement home banking of an asset and just trying to get a rent out of it under the philosophy of, hey, it'll be more in 5 years. I'm going to buy it now and rent it out
and at least cover their expenses.
Right. You're not sinking money into taxes, insurance. Worst case later, you're, doing a repaint and redecorating, but you're probably going to do that anyway.
Sure.
And if you're looking at 5 or 10% appreciation, it's a good bet on the money if that's where that person thinks the property value is going. I like to be in the bread and butter stuff. I mean, I want a duplex, that's a 6 or 7 net yield, and I want to be in the real strike zone for my personal investments. I feel like there's far less speculation in that take than saying, hey, if short-term seasonal rentals stay here and I'm able to get X percentage booking and they don't build a condotel next to me as they're developing. Like there's so many ands in that equation that I think you've got a really hard time predicting outcome versus this is a cookie cutter product. It's built well. And I kind of know what this is. Then your only real risk is rent sensitivity and whether the market goes up or down, but it's 1 instead of 10 risk factors to that asset.
And what is the deal size in the strike zone that you find?
Yeah, kind of depending on market, anything from 60,000 to probably a cap in the mid to upper ones, right? When you start into the 2s with a rental property, very few then have the commensurate rent to actually maintain the yield, either gross or net. It just doesn't tend to work out for that investor.
And what about age? So many of the folks on the institutional side that were asking for properties seem to be like asking for, we want 1985 and newer. Do you find that to be true too, or do you not care? As long as it's like, maybe it's for you, it's just brick and mortar. You want cinder block, and that's the only thing that's important.
It's funny. I advocated heavily for buying older assets when I was with Waypoint Homes. And we actually did get clearance from acquisition to buy a bunch of the 1970s stuff and Holiday and all of that, and go from a CapEx, an improvement threshold of say 20 to 25,000 max to spend 40 or 50,000 to put the house back together correctly. Cause you're now doing basically every major system to get it to par. The difference there, and I don't think institutions were wrong. One, it took longer. It took more time to manage. And if you're Blackstone and you're just trying to spend $8 billion as fast as you can and with as little error as possible, you're going for vanilla late model homes as fast as you can buy them, right? Like that was not a bad play. If you are an individual investor, there's always more opportunity the uglier something is when you go in it. The question is, have you found a diamond with dirt on it, or have you found a lump of coal that needs 10,000 more years to be a diamond, right? So you really have to know what you're doing. As an individual investor, I'm happy to go into the blown out house if it's got good bones and we can put the right amount of money in and actually end up at a lower overall basis, higher yield on renovating the older home. But if I was trying to do hundreds of these things and I had, third parties or, people that got trained last week trying to do this, I don't disagree with them. I would try to control the variables as much as I could. I buy later model stuff. And that was a wise play. And frankly, they were buying so cheap. I used to laugh at some of the REITs and say, these guys are 6 months just to get to an improvement, but they had the last laugh. They bought them for 35 cents on the dollar. Didn't matter when they got to them because they were going up so fast that it was outpacing all the rent they lost, not even getting to renovate the house or get it leased, right?
Are there things that you won't touch, like cloth wiring or galvanized pipes, or there are things you say, oh, that's
asbestos,
or there are things that you look at and go, that's a little bit beyond the pale for me?
I think for all but the largest investors who then have other motivations to not get into those problems, the people that are best equipped to deal with really hard stuff don't have the time or patience to get into it. The people that are least equipped often get into that stuff by accident. So yeah, you don't want to get into polybutylene piping. You don't want to end up with wonky breakers, aluminum wiring, all this stuff. If you've got it underwritten and you can recognize it and you have a real cost to fix it, by all means, rewire a house, repipe a house. But if you have no idea what that stuff costs, or you don't even know how to find it, then I might not go below 1978 in age just to avoid lead-based paint and a whole bunch of really wonky old stuff that if you don't know what you're looking for can be a problem. But that said, some of the best deals I've ever done personally have been older homes, where I knew it was a diamond. This thing's solid. Some old person took amazing care of it. And yeah, it needs a full aesthetic update. But, I've walked homes that are 60 years old with clean slider tracks. I mean, where somebody's literally on their hands and knees, dusting out sliding glass doors. And then I've walked stuff that people think is great. And you're like, that's asbestos tile. You had no idea that was asbestos, did you? That's all lead-based paint. Like, see that gunmetal color?
And please don't shuffle your feet.
Yeah, don't stir up any dust, please. So no, and it's amazing the people that will, we have people call us all the time and we'll walk into a house and say, oh my goodness, I wish you had talked to us before you had purchased this. I'm not here to talk you out of deals. We want you to buy deals because we want to manage them, but we might have helped you dodge a bullet had we just laid eyes on this thing before you wrote a check.
Now, as a property manager, that's what you're doing primarily now. You're a consultant and you're helping investment decisions, but really your revenue stream is primarily coming from property management. And you're correct? Is that correct?
That is 100% correct. We don't buy, we don't sell, we just advise. We are here to help owners, and our only job is to manage those assets. We put great people in assets and collect money.
Okay. And so you're getting them usually from some other manager. Can you maybe talk a little bit about some of the issues you have when you're taking over properties? Of like, what are some of the primary things that the previous manager's not doing that that you guys are having to clean up?
I will talk about that on two fronts. So there's performance issues, and then there's things I think a lot of investors don't realize about property management because the devil's in the fine print, right? So property management agreements typically read like you're selling your soul to some nefarious entity, right? Like they want your firstborn child. There's these crazy termination penalties. Even if they're annual, they run the entire lifetime of that resident. So essentially, as long as the human stays, you could, in theory, owe these people money, even if they're not performing. They make no performance guarantees on the part of the manager. There's just all this really crazy stuff. So people will call us and they'll say, hey, I'm paying this, and they'll send us their contract and say, no, you're not. You're paying 3 times that. You didn't read page 6, 7, and 8, where every time the phone rings, there's another fee. Every time they dispatch somebody, there's another fee. You have no idea what they're charging the resident. A lot of companies charge residents inbound maintenance fees. So every time that person picks up the phone to call, they're charged $25 or $50 to place a maintenance work order. But that's how you take a grout issue in a shower and turn it into a new shower because they don't want to pay $25 and you're now paying $1,000 to retile a shower because they didn't want to pay the $25. And this is one of the reasons we develop our own software is that if we just take for a moment the fact that we assume property managers are well-intentioned, right? There's 5 or 6 out-of-the-box platforms that all managers run out of. They're cloud-based. And the business model of all of those platforms, I don't think people realize this, have all changed to ancillary revenue. So a popular one, for example, is AppFolio. Somebody using AppFolio today is paying basically $1.50 a unit a month for the service. So they have 200 homes, they're paying $300 for that software every month to run the accounting, maintenance, and that sort of things. AppFolio charges $4 or $5 every time a tenant makes an e-payment. Right. So they're making $5. It costs them 10 cents to process the ACH. They're making $4, $5 on that. So when I first started in the business in 2007, I started managing my first single family home. I made $4.50 personally as a property manager every time a resident paid. It was great. I had a really nice BMW that I didn't have the license plate, but I should have, that just said check fees. Okay. This was great. There's all this ancillary revenue to the manager, which meant you didn't have to charge a bunch of junk fees. And what's happened is the software providers have hired more and more managers to say, hey, how are you getting revenue? We want to take that away from the manager and put it in the platform. So we're going to take the application fee. We're going to take the ACH fees. We're going to add all these things in. We're going to charge more for the maintenance module. We're going to do all these things. It forces the manager to create more junk fees. So jet fuel price goes up. Airlines charge for luggage. Right? Like they got to make money on this flight. So now I'm going to nickel and dime you from the moment you check in to the moment you check out. What they're really solving for is increased jet prices and you not wanting to pay more than X dollars for the ticket, but they've got to cover the cost to serve. And they're going back out here and coming up with all these junk fees that really upset us as consumers. It's the same thing in the property management industry, which is why we build our own tech. No one's going to tell us what to charge our customers. We take all those junk fees out of the equation. The other thing just comes down to a lack. So assuming you read everything in the contract, and I would ask a specific question, what's not shown in this what do you charge the resident that I don't even see? Because they don't have to disclose what they charge the other side of the equation, what might be in a lease. Okay. I read a lease the other day where a chunk of the security deposit was non-refundable admin fee to the manager, so the owner has no idea going into that agreement that part of the security they're getting to protect their asset is actually a non-refundable admin fee to that property manager at the end of the lease. Wow. So instead of starting with $1,200 to fix damages, they're now at $800. Right? Because the other 400 was the property of the manager now. The tenant signed the right of way, but I guarantee the owner doesn't know that, right? They don't know that there's maintenance call fees. Again, like, do you want deferred maintenance? Do you not want deferred maintenance, right? We've solved all of those problems over tens of thousands of occurrences, literally over 100,000 work orders completed since I started managing homes. And we know, what you can and can't get away with in behavior management with residents to create a solid experience for them. These are people. This is their home. They have holidays there. Yes, they pay us money, but we've got to love them and respect them. And if you treat a resident well, vacancy is what really costs an owner money. Right. And, unnecessary maintenance.
Turn is the biggest one.
Turn kills. But if you're nickeling these people to death and you're making it impossible to live there well, that $50 you wanted to charge them for a junk fee might cost the owner 2 months rent plus a turn cost, right? But they never find these things out. It's just not disclosing the relationship. So not knowing what they don't know. And then it just comes down to basic ability, right? If you don't have systems that tell you, So when you're a REIT and you're processing 3,000 rent payments a month in an area, you speak to global averages. What is my delinquency? What is my occupancy? What is my eviction rate across a lot of leases? And you're really trying to make big data decisions. What's interesting is as an individual owner, you only care about your house. You got 2 houses, right? You call me. I may be 99% occupied, but if you're 1 vacant, you're 50, right? You've got 1 of 2's empty. All you care about is why you're 1 of 2's empty. At the same time, as a manager, I've got to focus on global metrics because if I'm not beating the market globally, I can't be performing for an individual owner. But I don't think most smaller PMs roll up their data in a way that they actually hold their areas accountable. My Orlando property managers, our Tampa property managers, our Fort Myers, they know their global metrics. So I can look down from 30,000 feet and say, listen, there's an occupancy wobble going on there. That means some number of individuals aren't performing well, or that we wouldn't have that number. But if you're not zooming all the way out to see it from a high level, you wouldn't know. So, you ask somebody, what's your total delinquency? I don't know. I just know if you're collected. Okay, that's not the right answer, right? Like yes, that's all that matters to you as an owner, but really you need to know the big numbers. How are you doing as a firm? And are they even tracking that?
Well, talking of big numbers, how does the Florida market compare to the rest of the country? I know you've had some experience in other parts of the country. Prices have been rising in Florida. It's more difficult for investors. So do you feel like there's still runway?
Yeah, what are the institutional guys doing too? Like kind of what's the market temperature right now?
Sure. So there is obviously Florida's hot, right? Rents have gone up double digit for the better part of 8 or 9 years at this point. So a duplex in Lehigh Acres that we were struggling to rent in 2012 for $550 is now $1,100 a side. It's literally doubled in rent. So we've seen it come back to peak and yet pass some. At the same time, there are markets throughout the country that have maintained a little bit better yield, right? So I love Florida. There's opportunities in Florida. We wouldn't have opened in Florida if we didn't think that was a great place for us to be as a company and still have investment opportunities. But you got to be careful. You got to buy well. Okay. I wouldn't buy on the come. I'd buy good deals. Okay. At the same time, there are markets. So what we've seen the REITs do is continue to go more and more tertiary. Right. So they started, let's just take Atlanta, for example.
So they're still in the market and they're still buying.
They're buying heavy. First Key Homes, for example, bought 11,000 homes last year. There's people spending a lot of money on real estate right now. Some of it's roll-ups like so Waypoint Homes merged into Colony Homes, became Colony Waypoint. And then that was absorbed by Invitation Homes, which is now the largest owner in the country at 82 or 83,000 single family homes. Okay. But as these guys roll, they're still buying homes, not just large Wall Street roll-ups, but also buying homes. Let's take Atlanta as a market, for example. Atlanta was 5 years ago. Okay. People still buy in Atlanta, but for the most part, Atlanta was done a long time ago. Now they started buying Nashville. Well, now Nashville's hot, right? Nashville gets overheated, build projects everywhere. So now is it Knoxville? Like you just basically keep going an hour or two away from the last place you bought a little bit further out. So you had tier 1 cities, you go to tier 2 cities. I think a great play, and I actually can't believe I'm going to say it on this podcast, but what we advise large investors to do is to go to the market next to the one that the REIT's in, right? The one they don't know they have to go into yet, right? So the guy with 7,000 homes in Tampa, is he going to be in Ocala in 2 years? Only if he wants to grow, right? So do you go to Ocala? Do you go to Spring Hill? Do you just get a little bit further out than what they thought their initial territory was? Because as they gain density in a radius, it doesn't look that crazy to then go an hour further, right?
Bob Hope was once asked why he was such a successful investor because he made a lot of money in real estate. And they asked him what his secret was. And he said, well, I just go out to where they're building the new house and I drive a little bit down the road and that's where I buy.
That is the story. So, areas of the Midwest, I'm a huge fan of Indy. I love parts of, Tennessee, Kentucky. Like there's some great markets through there. The Carolinas are getting really hot. So everybody's hit Charlotte, Raleigh, Atlanta. Nashville is really overheated. Obviously you can't touch California. That play was a really long time ago. Vegas, Arizona, those markets are really tough now, but I would look at the towns you came from, not where you wanted to move. And that's where you should probably be buying real estate today in my mind. That's
are there any such thing? Is there any such thing in Florida or is everything just on the high burner?
It's hot. I'm going to be honest with you, but at the same time,
so Ocala, Brooksville, doesn't matter.
I think Ocala is still a little further down than there's still some yield there. It's remote. So you got to know how to operate it. We don't even operate there, right? So I'm telling you a place that we're not even in. Would you go pretty far east Orlando? I think the Space Coast has a ton of potential still.
Oh, man, I was amazed. It was a little over a year. I went over there and around the Titusville area and drove around. There's waterfront property over. It's kind of stunning. The problem is there's no jobs over there. But you look at the real estate and you're like going, oh my gosh, like waterfront, if this were in St. Pete in Pinellas County, good Lord, it'd be 50% higher.
So what history shows us is when we see those, oh my goodness moments, they don't last forever, right? If you're gobsmacked by the price of something, somebody else will be soon too, right? So we still I buy lots. We build our own spec homes every once in a while. Like I can't help it. It's my wife's like, you're busy, but why do you flip houses? Why do you do other stuff? We'll buy in an area. I've got a partner. We buy some lots. We'll notice there's utilities, for example, in an area of say Lehigh that nobody kind of realizes there's pipes in. You might have a week. We literally bought some lots the other day for $8,000 to $10,000. They got offers at 25 3 weeks later, right? We bought two, the only two under 20,000 in the market. We bought, and the next day everything was 25. Just because somebody woke up and realized there were pipes there. I wish I'd obviously bought 100 more the week before that, right? But people wake up all of a sudden, and then you can't go back to the week before. Yeah. We see that, I think, constantly in these areas. The holiday stuff, nobody would touch. Now that area is hot, right? You have to keep going further and further north.
You're talking Holiday, like
Holiday in
Newport
Pinellas.
Richie?
Holiday in Pinellas, yeah. That area was great for us at Waypoint. A lot of the other, your American Homes for Rent, your Invitation, they didn't like the age of those product. It didn't fit their 1990 plus buy box, and they certainly didn't like the level of renovation you had to do the older homes. And we got great yields out of those things. But when we started, that play was buy for 60, put 35 instead of 20 in. So you're in it for 95, and we were getting 1,400 in rent. Like, those are great numbers. Now that same house is $130,000, $140,000, and you probably still need to put 35 in. You might get 1,500 in rent. So it's still a doable deal, but it's not nearly, it's no longer a 15, 16 gross. It's a 10.
So changing subjects a little bit, the REITs have moved into the market, the single family market. They really were not here 10 years ago. There were fringe REITs that were doing this type of work, but we're talking about the large institutional guys like the Blackstones really moving in large. What is that market looking like? Are they here to stay? Is Blackstone, have they got their hit and they've moved on, and it's kind of the middle market guys that are in the business now? What does that look like now on the institutional side?
The same question was asked when apartment REITs formed, right, in the latter part of the last century. And that really changed the game in apartments, right? You went from mom and pops owning apartments to all these institutional level plays. Because the private equity companies, the Starwoods, the Blackstones have essentially exited, they still own some shares, but they took these things public. So now they're really in the public space. They compete with other property type REITs. The thought right now is that this is here to stay, and it has a lot of competitive advantages, right? The Wall Street owner is borrowing money at 3%, where we might pay 5 or 6, depending on our balance sheet, right? So they can win right out of the gate at the financing level. You say, why would these guys buy a 5 net when I need a 7 to make money? Well, because they borrow at 3. Right. And they get a really high leverage on that 3 too. So, 85, 88% of the cash they have sunk into property. So they've got some built-in stuff just at the banking level that we will never be able to compete with as individual investors. At the same time, they're not direct to the real estate, right? So the big litmus test for me will be, what will it be like for these large firms? Can they continue to buy or build to rent, or whatever that new vertical is, to add properties when it's not 35 cents on the dollar, right? It was shooting fish in a barrel that could only go up 7 years ago. Now what? What do you do when you have to play ball at retail? And can you still create yield through all these layers of team members and, all this stuff that separates the people running the fund or the REIT from the actual doing on the ground? And can they actually generate yield through a lot of that bureaucracy, right? There's a lot of people. You can have an asset manager watch 45 apartment complexes in a couple of spreadsheets. Watching 83,000 homes and deciding whether to renovate the kitchen in this one or not do that one or sell this one. That's a much harder problem to solve. It's not that it's insolvable. Technology's come a long way, but it's just a lot harder. That was when I got out of REITs, was when I found myself arguing with some kid 12 states away over what to do in an asset I was physically standing in. And they're telling me, my spreadsheet says this. And I'm like, son, I've been doing this for a decade. I'm telling you what to do. And they're like, no, the spreadsheet's okay. If we're going to use the spreadsheet, we're not going to win.
So, one of the things I've been meaning to ask you while you've been talking is, where did the name Great Jones come from?
So, yeah, that was actually the street. Great Jones is a really well-preserved historic street in New York where we actually started. We don't serve any customers in New York, but like I said, that's where our marketing, our technology group, my co-founder, Jay, who is a tech product and process guy, Stanford, Yale, just classic underachiever, this guy, and super humble. So he'll hate that I'm saying this about him, but just amazing guy. And so they're based there. And then we run ops, accounting, HR, the on the ground pieces are run out of Florida. But that was the street we opened on. We were at 9 Great Jones. And what we loved about it from a branding perspective is it meant absolutely nothing.
Yeah, I was searching for this deep meaning, but
no, it meant nothing other than it had the word great in it.
So, that's always good.
And was it bootstrapped or did you guys have funding behind you?
We are so blessed that we've raised a little over $8 million in venture capital. We are not 2 guys in a garage. And we're far beyond that, obviously, in terms of our team size now anyway. But we had a lot of people because of our backgrounds, our combined backgrounds of technology and operating experience that were willing to put in a lot of money. And our advisory board, our board of directors are just fantastic industry visionaries that really believe this industry is ripe for disruption, right? When you look at property management itself, the average property manager has 200 homes under management. The market is incredibly fragmented. So institutions own something like a little, give or take 2% of the 16 million-ish non-owner occupied homes in the country. The other 98% are owned by individuals, and they're managed by people who have managed at their peak, say 200 homes. That's a big disconnect. At 200 homes, you can't invest in technology. Mm-hmm. You can't hire world-class performers. Our typical regional leader has 2,000 plus houses under their belt, or they can't work for us. That's 10 times. We believe in the theory of 10x. That's 10x what most companies manage themselves. This is what these people have individually overseen.
So levering what you've been telling us, how, if an individual investor comes to you, like, what are the advantages? You've got the technology, you've got the scale that you could offer to that investor to manage his homes.
So for the non-growing investors, I've got 2 houses inherited. We offer an unprecedented level of transparency and trust. Just in this business, you can win purely on integrity and doing what you say you're going to do and just performing well. And then for the growth-minded investor, it's an entirely different conversation, right? So somebody who's really looking to build their portfolio, wants to invest better, they get an actual partner. Our growth team, they are not called salespeople. They are portfolio advisors. These are prior investment brokers, people that have worked heavily within commercial or residential income producing real estate that are able to really talk to people about the moves they're making. We're not we're not selling securities. We're not here to invest your cash in a fund, but we are going to help you. I want so much more for you than just to get one more contract under management. We're not having a problem with growth. People are flocking to us like you wouldn't believe. What we want is I talk people out of buying things all the time. I tell them a better way to do it or just what I would do. And that's far beyond me. You don't have to talk to Dave to get a real answer. Out of 30 people, 20 of them are industry pros and the other one's code stuff, and you never have to talk to them anyway, but they're still great people.
Nobody wants to talk to them though.
No, they're actually our tech teams are super interesting people. They're fascinating, but you don't want to, you probably don't want to engage on the real estate level with them, but you will have nothing. There's 2 compliments that somebody can pay us that just humble us to the core when they say, I've talked to multiple companies and you're the only ones that get it. And that provides, they had a preconceived notion of what getting it meant, but they're making a statement like that. Or they'll say something like, you're just the only one that sounds different. And then, which we love to say, right. And that should tell you everything, right? Like if I'm the only one out of the 7 people you've talked to that says something different about how this should go, that should tell you that there really is a status quo and that it's probably not the best thing, right? Yeah. If I had to pick between Uber and a cab, I'm going to go Uber all the time.
Yeah, it makes sense. So just before we start to wind down, is there anything else you just want to touch on for investors? We'd like to actually give them your contact details, and if they...
Yeah, please let us know how people can get in touch with you if they want some help on their homes.
Yeah, our website is greatjones.co. That's co, not .com. And hello at, or I am Dave at greatjones.co. So I give out my email. I give you my cell phone number. It's helpful. We're all reachable. People talk to me and my co-founder all the time, no matter how big we get. I think that's different too, is I'm on the phone with people on Saturdays talking about what they're going to do with mom's condo. That's fine, right? We're in this for the customer, which is different than sitting here wondering how to get more of their money in our pocket. But at the end of the day, even though we don't acquire, we can refer you to phenomenal investment agents that we've worked with institutionally in markets. They don't work for us. We don't make any money on that, but I'm happy to help you separate a good real estate agent from one that might not be an investment expert. We can refer in every market and help you acquire, but at the same time, our interest is really in growing our management base and helping people make wise decisions. I love residential real estate for the simple fact that it's highly fragmented, meaning you can get a great deal, you can get a bad deal, which means there's still gold to be mined in any given town, city, whatever.
Yeah, regardless of the market, there's always a deal.
There's always a deal, which is just fascinating to me that there's still an area of investment that's inefficient. We're not pricing commodities with functional levels and 28 graphs. Like, this is still really cool to me. And the other part is the fact that it's one of the few things you can invest in leveraged as somebody who's not independently wealthy. And we were talking about before the cast began, what else can you invest in, buy a property or two every year over 10 years, put them on 15-year mortgages, right? And by the time you're 50 or 55, have assets paid off by other people paying the rent, right? Have amazing cash flow if you choose not to sell them. So you've got either this great debt-free cash flow that you can go into your retirement with, or you've got a great nest egg to sell and live on or to leave your heirs. But there's nowhere that you can invest the type of capital that would take, which might be $100,000 or $200,000 over a decade, and get back the annuity stream you would get from real estate, right? If you go to your life insurance broker and say, hey, look, what I'm going to do is give you $200,000 over 10 years. And what I want back is $25,000 a month in 15 years from now, and I want $1 million in the bank, maybe $2 million in the bank. Can you give me that return? They're going to look at you like hey, that's mathematically impossible. And it is if the only input is the money you put in. But in real estate, you've got the people paying the rent putting in money for the next 15 years for you, right? You make one down payment and other people pay. And if you treat them well and you provide a great living experience, it's not a zero-sum game. You can help them. They can help you. I love that. I love that the little guy can do well.
Yeah, it's one of the few areas that the little guy can still get involved in. And listen, there's no guarantees in any of this, but if you're buying correctly, there's a relatively sure model there that an individual can make money. I don't know where else a little guy can do that.
No, I grew up very poor. I grew up on welfare. And when I saw this opportunity in 2009, I didn't have, my dad didn't have a country club I could go to and just raise a bunch of money. Like, I wasn't one of these guys. I was just blessed that I aligned with people because my prior finance background, I could speak the language that allowed me to sit in the rooms with people with really big money and help scale with them as a worker, as the guy actually going out and doing these things in real estate. But it's never lost on me that when you look at some of the great fortunes made in this country, it's either founding a business, right? Which that's why we're at Great Jones, right? We're doing that, but we're doing it by helping people in the other one, which is real estate. So we kind of get the best of both worlds. And, I would just, as one last thing, I would say, treat your residents like gold. You'll notice I've never used the word tenant as we've talked. Like, I don't believe in tenants. I've rented most of my life. We have residents. We have people who live in our homes. We're the guys who get you a stove the night before on Thanksgiving because we keep them in storage because you have to have a holiday there. Right? Like, this is real. Treat these people well.
Good words. Dave, really appreciate you taking time, sitting down and talking to us. It's a fascinating story. Stephen, anything else before we let him go?
No, I'm just kind of smiling because we had a mouse that I referred to as a tenant, but now I'm going to call him a resident.
That one you might want to evade with extreme prejudice.
All right, Dave. Thanks again, buddy. And that was David Diaz from Great Jones. Really energetic guy. Amazing the things that he's done already, Stephen.
Eric, he has another perspective, and he mentioned things I hadn't thought about. The power of big data when applied to property management. It's different, and they have advantages over people who just in on a much smaller basis. And then some of the basics about investing that we should never really forget about. It's not an efficient market, and some people will pay too high, and some people will pay too low, or pay low, but there's the opportunity to find gold nuggets.
It's always a deal.
And there's always a deal. And
Yep.
the fact then is that you can take that deal and leverage it and build a portfolio.
Yep. Stephen, David was a great guest. Where can our listeners find other great guests?
There's only one place to go, and you could go to the Invest Florida show. You could download the app on Google or on the Android or on your iPhone and listen while you're mobile or in the gym. It's a wonderful learning experience now, and there's a plethora of information.
Guys, as always, we appreciate the time that you invest with us each and every episode. And until next time, hasta la vista.
You've just listened to the Invest Florida podcast with Eric Odom and Stephen Silverman. Join us every week for actionable real estate investment ideas, and of course, visit our website at www.investfloridashow.com for more shows and tips on how to earn a cash flow in the real estate market in Florida. While hosts and producers of the Invest Florida show have no reason to doubt the validity of comments of our guests, we do not warranty their accuracy. Please check with your legal, financial, and tax advisors before entering into any investment. Returns will vary from person to person and deal to deal based on unique circumstances. All information expressed in this show is for educational purposes only. Opinions of the guests are not necessarily shared by the hosts and producers of the Invest Florida show.